Good evening. We're going to talk about something really interesting today in that we're combining fundamental information, technicals, to make an enormous amount of money almost every day this past week. And what we're showing here is a daily chart. Okay? We're somewhere in here and we're going to rally. We're going to rally to a 50%. Why? Because we're in the end of month markup. August was down about, at one time 18, 20%. We're coming in now and the market's down about 14 to 16%, and the market is due to rally. Now, everyone in the world wants the market to rally. Okay, so you have these end of month. Normally, portfolio managers are not involved in end of month. Only the hedge funds are. And, that's like a $2 trillion business, and you leverage that up, you're talking about some serious money. Anyway, the mutual fund business is much larger. They only get marked, quarter to quarter. That's when their bonus is determined, new money comes in, etc. But the hedge fund managers and other people want to see the market. It was probably the worst August we've seen in some time. So we're coming into the last 3 days of the month. Now, what also is going on, and I've been writing about this a couple times, is that we have asset allocation. The bond yields are approaching 2%. Everybody in the world, long bonds, is making a fortune, losing money in equities. So normally, let's give you an example. Normally, a typical managed account, pension account, is, let's say, 50-50. Well, after the bond rally we had, interest rates dropped from 4 to 2%, the account's probably 75% bonds, 25% equities. Well, what do they have to do by the end of the year? Their mandate says they have to be 50-50. Well, they have to swing out of bonds and buy equities. This is the nice thing about it. It happened after 9/11. The market was down 1,500 points in the week after 9/11 when the market opened, and yet the market rallied 25, 22, 23, 24% into year end, and nobody could figure out what was going on. It was the bond market exploded. People had made tremendous amounts of money in bonds, had to switch back into equities. Well, we're faced the same problem now. Nobody realistically can meet their bogeys. No corporate manager, no pension fund manager can meet his bogey when he's getting 2% on his money. So what happens is the bonds have appreciated dramatically. They're now going to sell bonds. In fact, Goldman Sachs announces, I think on Monday, that $150 billion is going to be moved out of bonds into other assets. And stocks primarily going to benefit. Now, knowing information like this is very helpful because we're going to be selling puts and buying calls. We're going to do the SPYs. This is something different. I've just started using the SPYs because I can trade every day. The volume is big. The OEXs don't trade the first 3 days. So we're looking at a market down in here somewhere, and it's going to rally. It's going to rally. We roughly know where it's going to rally, but basically it's going to rally. Okay, it turns out it's going to rally to a 50%. So what I'm going to do is I'm going to drop down to the 30-minute chart, and I'm going to show you all this rally. I'm going to show you this rally. Okay, here's what's happening. So we're getting long into strength. We're getting long puts. Now we're hedging. We're buying. Okay, the market goes higher, comes down. Okay, we hedge, we go long the S&Ps, S&PY, SPYs, whatever you want to do, E-minis in some fashion. Usually E-minis 1 to 5. The SPYs 4 to 10. About 40% long, 20% long with the E-minis. Now here's what's happening. We're now getting long. You can see the oscillator getting jammed. Jam 44. You all know this. Jam 44. Strong signals, okay? And finally, later in the week, we're going to get this leading divergence. But anyway, let's play the game. We go long the puts. Now, why am I going long puts? Because everyone in the world wants to own calls. Puts are much cheaper. And we want to have the open-ended side of being long futures. If the upside is unlimited and I have a defined risk, what am I going to do? Just like I wrote in the email, the blog. I want to be long the open-ended side. Anyway, this rally here, this is in excess of 10 points. This is $500 an option. Well, if you buy the option at 75 cents and you're making $500, boy, oh boy, you're doing all right. Meanwhile, we make our $500, we do a couple of trades, we come down again, and we sell the 18s, which we buy at 70. We sell them at 80 cents after we made $500. Now we roll up, because what happens is as the market is going higher, we're looking to roll up. So now we buy the 120s at 95 cents. Go from the 18 to 120. They come down here, we go long, we catch this entire gap up. Also, in this rally to higher highs, they hit 72 cents. We can average in, they go down, we go long. Now we can kick it out at the end of the day and buy it in the overnight session, and we catch this whole move up. Again, 44, jam. 44, we want to be a buyer on weakness. So we're hedging this whole time. It's a C5-minute chart for the week hedging. Each one of these trades is worth about $2,500 against the purchase of 10 calls. I'm doing 10 and 2s. We're against a $750 investment. So you're making about 3 times your money, and the market is rallying. Now remember, this is markup. Every day the advanced decline line is 3, 4, 5 to 1. You need at least 3 to 1 advanced decline to show you they're marking it up. Now here, we come up to the highest. This is the 50% of 7.7. If we go back to the daily chart, here we are. 50% of the entire down. Okay, I'll show you what I'm talking about. Here we go. Look at this. Whoops, I don't have the 50% in here, but here's 50%. Don't ask me what happened. I thought I had it in there and it got wiped out. Okay, but this is 50% of this down move right back. So 50% of rally, there's going to be some sort of reaction off it. Okay, so we're going to come down. Right? Again, shallow rallies first. Now we're rolling up into the 22s. Because what happens is if the market goes up and you're still long 118s, you have no protection. The market is now 40 points higher. 40 points higher. There's no protection if the market comes down. You want to start rolling up. You make a little money on the puts. You make most of your money on the long S&Ps. So here we are, long the 20, average price roughly 81. I recommended it in an alert. You know, see the thing I did alert, say buy it under $1. Most of the prices were bought around 90, 88 cents. The low is 88, 81. We bought around 88 cents. The market comes down, we make some money. Now, what I'm going to do is I'm going to show you what happens. The market comes back, tests a high, but look at the premium. It's gone. You can see as it's running out of time. This is Wednesday, they're 81 cents. This is Thursday, they're 57 cents. And you can see they hit 440 on Friday. It's incredible. And now I'll go through the story on why we're long puts, what we're expecting. We came into a week expecting a markup. The markup is the last day of the month. This is the last day of the month, 8/31. We got a markup. The markups generally end 1 o'clock, 2 o'clock. Okay, I'm going to show you that on the 5-minute chart. So nobody wants to get in the way of this markup. Even the shorts are not stupid enough to fight this. Because you got 8 to 1, 7 to 1, 6 to 1, advanced declines. You got 11, 1200 ticks. The market is blowing out. There's a buy program in there. The shorts don't want to get in the way of that. So the market goes up, and the shorts are smart enough to know that they're going to see a failure, and they're going to get short, and they're going to make a couple bucks. That's what you do. You just don't get in the way of this. I've been doing this 28 years, watching these, 29 years now, watching these markups. It's totally illegal, but it goes on. You can't prove it. It's very hard to prove these. I did it all the time. I managed money for 20 years. I marked up my portfolio at the end of every month, every quarter, every year to make sure I got paid. Okay? So anyway, this is what's happened so far. We got a markup. It's going to end on Wednesday, which is the 31st, and then the market's probably going to drift off. Why is the market going to drift off? See, you have to understand the fundamentals. This is a markup. Now we're going to expecting a bad ISM number. The ISM manufacturing number should be lower. The expectations are going to be under 50. Okay, and then we have an unemployment number, which is going to be a disaster, probably 50,000 or less. So now we want to get short. The market is marked up artificially in the end of month markup. Now we want to set up puts and get short because we now want to make money with the puts. We can buy calls and short S&Ps. We can do either one. But since we've been in the groove, buying S&Ps, buying puts, we're going to stick with puts. Now what I'm going to do is drop down to the 5-minute chart. Now here is Wednesday, the 31st. Okay? We're rolling into the 5. This is my on the alert. See alert. Okay, we're rolling up into the 122 puts. Resistance 28.30. Look for puts. ADs open 7 to 1. They're continuing the markup. Now here's 50%. Okay, we're right up here against 50%. You can see jam. The market is very strong. Okay, and all of a sudden we come down. I had a little support line here. I see it's gone. I must have erased it as we went through the days. You can see support resistance right across here. Okay, and I can show you what I was talking about. Let's do this. Okay, here's support, here's resistance, and you can see the line. Okay, so what's happening now is the markup's probably over because we're now making lower lows and lower highs. The markup's over. Hedge, okay? You're selling all the 120s because what we did in the alert was Buy the 122s, hold the 120s, on a weakness, sell the 120s. And you ended up making money, believe it or not, on the 120s because the market went down. Okay? Look at this. So we're now in the market, a buy 81 to 21, we're hedging. All these hedges. And the markup, by the way, guys, was 10% since last Monday. That's incredible. 10% rally in like 5 days because of the artificial nature and the asset allocation. If you don't understand what's going on or understand how to use the information, like I wrote in the blog, you're fighting with both hands tied behind your back. You shouldn't even be trading if you don't understand this stuff. You have to understand. That's what's in the Bible. That's what I've been doing for 47 years, is trying to relate the fundamentals to what's going on in the market and then give you in my chat room, give you in my charts, give you in my alerts what the heck's going on. Now look at this. Here's a perfect end of month markup that ends early the afternoon of last day. Look at this. And right under, we break out. See, this is multi-day support. We break out and fall back under, and we never get back up. Markup's over. Advanced decline, 7 to 1, now 4 to 1, dropping off. Now 3 to 2. So you're beginning to see how weak it is. Now you're in the puts. Now what you're doing is you're buying the hedges. See, buying the hedges, buying the hedges, buying the hedges. You're paying for the puts. Look at this market. I'm holding. See, an alert goes out too. I'm holding the puts, hedging for the ISM numbers. The ISM numbers are going to be bad. ISM number tomorrow at 10 can surprise to the downside. I'm looking for an ISM number under 50. I think the number expectations for like 49.5. It was 52 or something the month before. Okay, now look at what we're getting here. A little leading divergence. Okay, so we're hedging. The options go from 81 cents to $1.75, basically you double your money. At the 30-minute mid-June, good level. So we're going to hedge again. We're hedging. So you've got leading divergence. Okay, one of the few places you have different divergences. All right, look at that. Look at that hedge. Look at that. That hedge alone going from a low, let's see if I can even pick up the number, 1207. Look at that. That's 10 points. That's $500. You make $1,000. You paid $800 for the option. You can see this is just 2 S&Ps. You make $1,000. You paid $800 for 10 options. That's incredible. And you're at a good level. You can see the leading divergence. Now we're coming into the next day. See, the market sells off a little bit. Now we're coming in. See, I'm waiting for the ISM number. Well, we had a hedge. The market came down. We bought. Okay, overnight. Now look at this. The market comes down, gets oversold. We're close enough to the low here. We're going to hedge. We have to hedge. The number's coming out. If it goes lower, we're going to buy. We're going to buy 2 S&Ps. We're still long 10 S&P options. Okay, probably average price somewhere around, I don't know, 80, like I said, 88 cents, 82 cents, whatever it is. Now look at this. The market rallies. Guys, this is 15-point rally. This is $1,500 against an $800 investment. We just made $1,000 here. Here's another $1,500. That's $2,500 plus an overnight hedge. We earned another $500 per contract. Okay, so now we run up. We go right back to resistance, right back to the previous day's high. What are we going to do? We're blowing out a long and we're bidding for the S&P. Now look at this. The market's back to the high. Okay, the number was a little better, but when you analyze the number below, it really wasn't that good. And Goldman Sachs, right in the middle of the trading day, came out and lowered their forecast after doing an analysis of the ISM number. That the unemployment number, instead of being 50, was going to be 25. Well, guess what? When that comes out, bang, they start hitting the market. Okay? See, the dollar rally weighs on the markets. That's why the market started off lower. Okay, so now we're coming along. Boom, 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 boom. Okay, the ADs are flat. I mean, it's not support. How the hell can you support a rally when your ADs are flat when they were 9 to 1, 3 to 1, 8 to 1 during the markup period? Market's not going anywhere. Okay? So what happened here? Goldman reduced here. Look at that. Goldman reduced jobs estimate 25K from 50. So you can see now the market's coming down because the number is going to be even worse. I saw a number of 70, 80,000. Now we're talking about an even worse number coming out. So you can see the market coming down. Okay. Today we had another 500 hedges net. This is for the first 3 or 4 days. We're making over $2,500 on an $800 investment. Now the number over $3,500 possible. See, I'm not even talking about averaging 57-cent options. I'm talking about 90-cent options. I recommended the purchase of these things at under $1. They went to 81 cents. Here they're 57 cents. So if you averaged in, you're talking about $3,500 probably on an average price of like 70 cents. Not too shabby. Anyway, here, Goldman reduced the job. Here's multi-day support. Okay, we're down in here. We're looking to buy, and like I said, oversold. We're looking to hedge the number. They're oversold. The number can surprise. The number's surprised in the past. Okay, now here. Bond prices are through the roof today. Lower interest rates, higher gold, negative for the market. That's just the opposite of what happened today. Gold was down $70, bonds were down 2 points. The market went up 33 S&P points. So all you got to do is watch gold and bonds. You know what the hell's happening in the marketplace. Okay, look at this. AD's negative. 1,100 ticks. 1,100 ticks. See, hedge, we make a couple pennies here. I mean, look at the market, though. The market is failing. Here's resistance now. See, this is resistance. Okay, now we're rolling along. We're rolling along. Look at the market start falling off the page. Once we fail underneath the mid-June, look at the oscillator. Look at the oscillator. It's getting weak. Now we're starting to get jammed. This is terrible. This is terrible. Market can't even rally. The options go from 57 cents, $1.50 hedge. Still trying to hedge. Still resistance here. Same resistance here. See, we fell off the bottom. Support becomes resistance. This is support. Becomes resistance. The oscillator is trading between jammed and 62, just like you've seen on all my other charts. Jammed. Look at this. Look at this. The ADs are now 1 to 3. Okay? I forget what they started. They were flat. The market's going back to the high, and the ADs are flat. See that? ADs are flat. Here we're 1 to 3 negative. Now we come across leading divergence. Okay, puts a trading over $1.50. I'm staying with the hedges. Now I'm sending alerts out all this time saying what's going on. I'm telling you, I'm staying with the options. I'm hedging. I'm staying with the puts because we have a horrendous employment number coming out tomorrow. Could be a big negative surprise. Okay, boom, boom, boom. The market's failing. The market failing. Market closes out. I'm staying with the hedges. This chart goes out at 345. I'm staying with the hedges. Hedge. I'm not selling mine. I'm not telling. If people want to take profits, they just triple their money. They can take profits. I'm staying with the hedges. Look at this leading divergence. Look at it. Market hardly rallies. Piece of shit. Pardon my French. See, 62. Jam 62. Again, trend down. Now, guess what? Okay, there's a gigantic hedge in the morning. Okay, Euro's getting killed. Gold and bonds higher. See, again, gold and bonds higher. Terrible. Everything is news driven. Europe's a mess. Hello, QE3 jobs in line with expectations. You know, it's supposed to be 50. Came in 0. I mean, unless you were really down big. It was really the European situation. Europe was a basket case. Okay, Europe's what's driving this market, not anything we're doing. Okay, SPY sell 393. Sell half, hits 380, sell most. Hedge the balance. Holding in front the market. I came out with an alert saying the market probably will make a low the first hour. Okay, we're holding in front of the 20-day moving average. See, we can go back to the daily chart and see that. Market's holding right in front of the 20-day. So we shouldn't get too killed. Okay, we shouldn't get too killed. All right, so that's why we're starting to sell the puts. We paid 70 cents, 80 cents, you know, they're now $4. 5 times your money plus all the hedges. Each day you made $3,500. This day you made about $5,000. You know, with the hedges there. Now look at this. Here is a bigger resistance area. Don't ask me what's happening here. Bigger resistance area. We're holding in front. So now we're just selling. Hedge, 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 hedge. Look at this. Look at the comment I wrote on the chart here. 1 year Greek paper yields 71%. 2 years 48. This is now over 71%. This is over 50. Now I don't know what happened, you know, today. This is over 18%. Yipes. All long hedges should be sold. Okay? So we're getting out. All long hedges should be sold. We're failing under. Remember, support becomes resistance. This was a big support area. It becomes resistance now. Okay, we look at this. Look at this. Boom, boom, boom. Okay, alerts go out. Scaling out the remainder of the puts. Okay, scaling out. Look at the ADs. 1 to 6. They were 1 to 10. Still horrific. Still horrific number. You can't buy this. You got to sell. And look at this. Look at this resistance. It's beautiful. It's just telling you to sell. Sell. Hedge, sell. Hedge, sell. Hedge, sell. Hedge, sell. All these things going down. But now we're just scaling out of the puts. Okay, scaling out, scaling out, scaling out, scaling out, scaling out. Okay, scaling. Orbo. Now this was, we had a break here, and here's a little support. We have opening range breakout. We did manage to go below the 20. See, we did break down. Okay, we did break down. See, right here is the orbo, becomes resistance. So, yeah, 60, that's a big number. The market can't rally. Market goes down, does another retest, can't rally. Okay? So basically what we're doing is we're looking to get out of the last bit of puts. Puts at 440 from 60 cents. That's about 7 times your money, though in the ones you bought lately. Now what I write, I don't send out alert. I just talk to the people in the room. Throwaway trade on the 18 SPs under 50 cents. They hit 8 cents. I'm not buying them anywhere. They hit 8 cents. I said, shit, that's a throwaway trade. Okay? They go to 27 cents. I triple my money, I'm gone. Now we can hedge down, and this is like another triple. See, it gets overbought. See, overbought. Now I took some of these away for the newer charts, but you get the cross with divergence. So see, this is what I'm saying. Here you want to try it. See, in here you want to try the longs. Okay, so all we did was make marginal lows, just slightly below the 20. And they hit 8 cents. I mean, it's a throwaway trade. Take a shot. You know, I recommended them an alert. I mean, in the chat room under 50 cents. Didn't do anything here, but here it is. Cross with divergence. Okay, and we finally get, and look at this. This is jammed. This is jammed. We're now coming in after 3 o'clock. We can't take out the low. Okay, so we get a pop to the 40 ID. 40 of the day. And again, resistance, resistance. Okay, walk away, hedge, you make a couple pennies. Guys, we have a situation here where we knew going into the week the market was down 14, 18%. They're going to buy it. We knew there was a buy program on Monday for asset allocation. We knew stocks were going to get their... See, you have no way of knowing what all this means. There is no way in God's creation you can understand this information and make money. We knew the market was being made up. We knew $150 billion were coming out of bonds. We knew a fair share was going to equities. We knew it was going to end. The short's going to come back in. We knew there was bad fundamental information coming out Thursday, Friday. Now, the information on Thursday was a little better. We didn't care. The number on Friday was going to be bad. So we wanted to sell. And when options get to be 57 cents near the money, with a day to go, that's a throwaway trade, guys. The market dropped 40 points. The options went to $4. It's 7, 8 times your money. That's what this game is all about. If you can put this together and understand why the market does what it does, when it does what it does, and how to play this and balance it with these cheap expiration options. We can't do the OEX Monday, Tuesday, Wednesday. Just don't trade. But they trade 10, 20, 30,000 Monday, Tuesday, Wednesday, and they trade 40, 50, 60,000 Thursday and Friday. We can make money. Now, we need gigantic moves, but if we can hedge it, we've paid for them on the first 2 trades. We really don't care. And then we position ourselves to make this extraordinary amount of money. Then my email, my blog goes out saying, I think the low is going to be 1125.50. The market on Monday hits 1136, and I can tell you it's up around $1,200 tonight. I mean, that's the kind of information you're getting. That's what you want to see. You can read the blog on my website, New Era Trader, telling you what the low is going to be. 3 times we've tested this low. I think the low is in for the year, unless Europe blows up. And there's a possibility that can happen, but then we'll adjust for that. Meanwhile, there's great news that came out today. The market exploded. Everything was up except gold and bonds. So again, these are the kind of things I'll let you know. You come into my chat room, you read my blogs, you'll understand what's going on. You take the course, you'll learn. All right, guys. Thank you. Have a great night, and look forward to my next video.